So maybe that's the one.
Yeah. But they had a very big garage on it.
Sorry I'm a little late. We've had the Family Guardian AGM, and you know, when you're in the back of the room, you're trying to walk out. I had a jacket and tie on. I immediately took that off when I got in the car. You know, I want to be a little relaxed when we're having a discussion. But needless to say, everybody was trying to get my attention, and you know, and it's also good for one's career to chat to everybody on the way out. My name is David Slatter. I'll put my name and my email up. So if you have any questions after class, feel free to email me. Okay. Slatter, all you do is take Platter, drop the P, put an S, and get Slatter. Most people want to pronounce it Slater. So my personal email is dwslatter@gmail.com. Or you can get me at work at dslatter@familyguardian.com. Give a little bit about me, and then you can tell me a little bit about you, so we all know who we are and why we're here, and I guess if I have a better idea of what you're doing as far as your current work, as far as maybe tweaking the course, you know, over the next few weeks to deal with some subject matter that may be more pertinent. So, David Slatter, I'm currently with Family Guardian. I've been there a little over 2 years as the VP of Investments. Prior to Family Guardian, I was at KPMG as the head of valuations, and prior to that with Fidelity Merchant Bank as the investment manager / corporate finance manager. So that's kind of my career in a nutshell. If we go back far enough, I pushed paper at CIBC in the commercial banking section, but I had enough of that and moved into the investment world. Your name?
Hi, I'm Giovanna Evans. I work at CFP. I'm currently a trader.
Okay.
With international and local stocks.
Okay, very good.
And I've been there for 4 years.
Excellent. I did a little
Hi,
Fidelity for. Sorry, go ahead.
Alma McIntosh, and I'm presently with Excel Partners, which is an external asset management company.
My name is Therese Mazet. I work at Deloitte & Touche.
At Deloitte & Touche? Okay. External auditors of Family Guardian.
Don MacArthur, Securities Commission compliance.
Simon Accounting BA and Financial Ordinary.
Melissa Hall.
So,
Melissa Hall and Co. and Melissa Hall and Co.
There you go.
Correct.
Are you an attorney, or is it?
I am an attorney.
All right. Well, the criteria for this course. Today we're going to talk about time value of money, and for some of you it may be old news. Some of you it may be new, but it's important regardless. So maybe if you haven't dealt with it for a while, it's good to get a little refresher. If it's new to you, then it's important to understand how, in particular, if you look at different types of investments, whether they be bonds or you look at annuities, how they work. And then the second part of the course, we're going to look at some of the savings and investment products that are out there to be considered, ranging from fixed income to equity and derivative products. And then after that, we're going to get into more of the, what should I say, the investment management side of things. We're going to talk about portfolio management, what are the fundamentals of portfolio management, know, you chat with somebody and, well, you know, that investment of yours, it'll take you over 14 years for that to double at that rate, you know, and you don't need to explain the rule of 72 to them, right? All right, now we're going to go through this. There's no way this is on the exam, I don't think. Where we're trying to solve for t, the exponential, how much time. All right, it involves a little logarithmic manipulation. We'll go through it. I don't think they're cruel enough to put that on the exam. All right, let's just work through this example. That said, I'd run it by Miguel. So, in this example, let's suppose to come to the, all right, so we did the rule of 72 and we came up with 7.2 years. Now we're going to test that rule of 72. So to come up with the exact answer, we can again manipulate the basic present value equation. Present value is $50,000 and the future value is $100,000. With a 10% discount rate, the basic equation takes one of the following forms. Okay, so why don't we, I'm going to make some space here and then we'll go to our good old future value calculation. Future value equals present value times 1 plus r to the t. Future value is 100,000. Present value is 50. Because we have that over here, right? I'm going to go back being disciplined. You read the question and you write down what they give you. They gave you the future value. They gave you present value. And what was the rate of return?
10%.
10%, because 72 divided by 10 is 7.2, and that's what we're testing, right? T is the unknown, that's what we're trying to solve for. So we need to figure out how to manipulate this formula to solve for T. Plus 1.1 raised to the T. Okay? And unfortunately in your notes, where you see T, that should be an exponential. So, if we divide both sides of the equation by 50,000, times, right? Add a plus there that shouldn't have been there. So we divide both sides by 50, we get 100,000 divided by 50,000 equals 50,000. Times 1.1 to the t divided by 50,000. These cancel each other out, and this is the same as 2, right? Not the same as, it is 2. It's almost kind of sort of similar to 2. No, it is 2 equals 1.1 raised to the power of t. Well, what you do is you take the natural log of both sides. If we take the natural log of something raised to an exponential, that process takes that exponential and brings it down and makes it just like a regular variable. So if I take the natural log of 2 equals the natural log 1.1 to the t, which I write exactly as we have it here in the book, we end up with the t, so we're taking the natural log of that, right? The t comes down. Don't ask me the mathematical reason for it, it's just the way it is. Some dude in 1802 in France came up with, who knows, you know. Actually, probably some Greek philosopher in 500 BC solved this. And then the Romans forgot about it, and we didn't remember it until 1500. All right. Natural log of 2 equals t times natural log of 1.1. So now we can say that t equals the natural log of 2 divided by the natural log of 1.1. What is that? I'm not calculating again. It equals what? 0.0. Let me bring this over and write it up. This is basically, this is kind of a proof to show you the rule of 72 is pretty accurate, right? Equals 0.693 divided by 0.0953 equals 7.27. So the rule of 72 is not exact. It's off slightly, right? It's not 7.2 years, 7.27 years. All right? And that's the trick there, right? This is the little tricky bit. It's taking the natural log. And on your calculator, right, ln, natural log, I'm going to do a test here. ln. Yeah. So the symbol on your calculator is ln. So all you do is you plug in 2, hit ln, and you get 0.69. If I multiply it by 100 to take the decimal out, 0.6931. Okay? And I take 1.1 natural log, and I get 0.0953. Okay. So the rule of 72 is pretty damn close, right? It's a pretty good estimate. In the scheme of things.
This wouldn't be on a test, right?
You can do that.
They probably lost.
What's the nature of the exam? I mean, I've been teaching the class a few years, but is it on a computer?
Yeah.
So is it multiple choice?
Multiple choice.
And each question has the same value?
We don't know.
Okay. Test taking strategy. If all the questions, multiple choice exam, and each question has the same value, are you able to go back and change your guess later on? So I didn't CFA exam.
CFA, yeah, exam.
Yeah, we gotta find. I mean, I don't design the exam, to be honest. Hey, Miguel.
Yes, sir.
The multiple choice exam. When you're taking it, can you go back and make corrections or change your answer?
Yes, you can. You'll see all 150 of your questions. You can slide back and forth.
Okay. So what you do when you get to a question, are they all worth the same?
Yeah, you have to answer everyone. Everyone you don't answer, you're automatically wrong.
All right.
Okay?
So here's how you take your exam. As you're going along, right, when you get to one you don't know, guess it, but make a little note saying 32, I guess. All right? And then come back to it. Don't get stuck on one problem that takes you 5 times the amount of time to answer those easy ones, right? Guess it, answer the easy ones you know, then go back and deal with the tough ones. And always guess the same answer. Assuming that the answers are randomly distributed, A, B, C, D. How many? A, B, C, D, E?
Yes, 4.
4. So it's only 4, A, B, C, D. Assuming that the same number A's, and same number B's, and same number C's, and same number D's are in the exam, therefore randomly distributed, always guess the same one. Because if you guess 4, the odds are you're going to get 1 guess right. Right? Because in theory there should be 1 A for every 4, right? So if you guess the same one. This is my test taking strategy. This is how I got through level 1 of CFA. 180 questions, 1 minute per question. Go along, keeping track. Question 30, 30 minutes. Question 40, 40 minutes. Guess, put a little pencil mark because you this is with the pencil. Poop, I was done, I still had 20 minutes left, then I went back to the ones I guessed, and many of them I was able to figure out, and it was no longer a guess. I had weeded it down from 4 to 2 options. I got a 50-50 chance. Some I knew. So that's how you pass the multiple choice. I love multiple choice. Because you may not know how to do it, but you eliminate something. So that's crazy. That's not the answer. I know it's not that. So now I've got to guess at I got a 1/3 chance of guessing right. So now I've improved my odds, right? You can weed it down to 2, it's a 50-50 chance. I guarantee you that's why I got through level 3. Because in the accounting section, maybe it was level 2. I don't know, man, it was in the afternoon, so I was dead. I was tired, and this was my weak section. And I got the results back, and I said, man, this is good guess. All right. So that's how you determine the T, the number of periods. I just gave you the key to doing multiple choice exams. Keep track of time. Make sure you're not falling behind. You're ahead of time. Guess, same answer. Go back and deal with the ones you guessed. Don't have to fill in, guess the last 10. It turns out those are the 10 that you knew, or they were easy. 8 of them were easy, and you guessed the wrong answer, right? All right, what are we on now? All right, future value with multiple cash flows. All right. Getting a little tougher now. I need my glasses. So suppose you deposit $1,000 today in an account paying 7%. In 1 year, you will deposit another $1,000. How much will you have in 2 years? Okay, so this is where you're able to invest $1,000 a year. So you know you get a gift or a bonus every year of $1,000, and you're investing it. And you know you've got one of those mutual funds out there that's kind of a diversified fund, a little bit of equities, a little bit of bonds, a little bit of preferred shares, and you get a 7% return. Or you know there's a preferred share you can invest in that gives you 7%. In 1 year you will deposit another $1,000. How much will you have in 2 years? This particular problem is relatively easy because we're only dealing with 2 periods, right? When you start dealing with monthly contributions over 30 years, and you start dealing with what? 12 times 30 periods, it becomes a little more, 360 periods, it becomes a little more. Doing this manual approach is not feasible, right? So, at the end of the first year, you will have $1,070, okay? Because your first 1,000 earns 7%, which is $70. Then you add another $1,000 to your deposit, so now at the beginning of the second year, you have what? 2,070, which you leave on deposit. I love that. On deposit at the bank, 7%. You must be dreaming. You almost got to pay the bank now to hold your money in. All right, so especially with that $1,000. So you got $2,070 on deposit at 7% for another year. At the end of the second year, that's worth 2,070 times 1.07 gives you $2,214.90. Okay. Then we can look at the present value with multiple cash flows. Very often we need to determine the present value of a series of future cash flows. As with future values, there are 2 ways we can do it. You can either discount back 1 period at a time, or we can just calculate the present values individually and add them up. So suppose you need $1,000 in year 1 and $2,000 more in year 2. If you can earn 7% on your money, how much would you have to put up today to exactly cover these amounts in the future? So how much do I have to put in today, knowing that at the end of year 1 I'm going to take $1,000 out of my investment, and then at the end of year 2 I need to have $2,000 remaining. Okay? And you know, you may say, I've got a child going to university, and I wish it was 1,000 or 2,000. I will need $25,000 in year 1, $30,000 in year 2, $33,000 in year 3, and $35,000 in year 4 because tuition goes up every year. What do I have to put in today to be able to do that? So that would be more of a real life example. But let's stick with our slightly simpler example. So the present value, suppose you need, we went through that. In other words, what is the present value of the 2 cash flows at 7%? The present value of 2,000 in 2 years, at 7% is 2,000 divided by 1.07. That 2 should be an exponential. Another type of or formatting issue. All right? So when we take 2,000 and divide it by 1.07 raised to the power of 2, we get a present value of $1,746.88. What is the present value of $1,000 in 1 year? 1,000 divided by 1.07, we get $934.58. Therefore, the total present value is those summed up together, or $2,681.46. Now let's see if that is indeed correct. If I take $2,681.46 and multiply it by 1.07, I
I get $2,869.13. If I take out $1,000, that leaves me with what? $1,869.16, which in turn earns 7%, and at the end of year 2 I've got $2,000. So that's a way to show that it is correct. Okay. So this example illustrates the present value of a series of future cash flows. Illustrates that the present value of a series of future cash flows is simply the amount that you will need today to exactly duplicate those cash flows, future cash flows, for a given discount rate. All right. An alternative way of calculating present values for multiple future cash flows is to discount back to the present one period at a time. Before I go on, why don't we do a nice quick, I'll put up a table, do an example of how the price of a bond is determined. All right. Do I talk about that later on? And the next page, I got kind of an example of it, right? Multiple cash flows discounted back. But in this case, it's just 1,000, 1,000, 1,000, 1,000. All right? So we'll go through that as well. But let's talk about a bond example. How are bonds priced? Now here in the Bahamas, of course, we live in our own little bubble. Yes. And central bank makes a market and everything trades at par. So all bonds are $100. All right? In the rest of the world, bond prices are fluctuating on a minute-by-minute basis based on interest rate expectations and credit risk expectations. But we live in we're kind of sheltered, right? Fixed exchange rate. All bonds trade at par regardless of the coupon and maturity date. Okay? So that's our little bubble. If suddenly all the government bonds are listed on VISIX and secondary market players got in and started trading, life would be different. All right? And one thing the government is doing right now is issuing fixed rate paper. Like they did the 6-month paper at 3.175% fixed. They've also issued, what was it, that paper a year or two ago at 4.35 fixed. I think they intend to come up with 3 to 5 year paper at 3.75% fixed. So what they're doing is they're issuing fixed rate paper at different maturities to create a yield curve. All right, because especially if that fixed rate paper starts trading, we'll have a Bahamian yield curve. Now, what I do is I come up with my own implied Bahamian yield curve, and I take the U.S. yield curve, and I add on a spread for credit risk, right? So we're BBB plus, the U.S. is AAA, except for AAA, AA plus. And therefore, there's an implied credit spread of, let's say, 2%. So if the U.S. yield curve is this, I tack on 2%, and I've got a Bahamian yield curve, implied. And that could be useful if somebody comes to you with an investment, we think we should issue this paper at, what, X%. Granted, a lot of liquidity out there, so everybody's coming out at lower rates. I think Abaco Marcus has got a lovely announcement tomorrow at their AGM.
Yeah, 5.6%. 6.6%. Yeah. We said it's 5.78, so it's a good rate that they're coming out with. Our own restriction.
Do you think that's?
So yeah.
Yeah, I think everybody's going to take it.
Of course.
You know, it's a shame to lose what 1.25 or whatever. All right. So let's value a bond. Not in the Bahamian context, but in the way the rest of the world would value a bond. And the Bahamas government has issued U.S. dollar bonds, which trade on the global market, and those prices fluctuate. So let's suppose we've got a, let's come up with an example. Trinidad TNT bond, right? And it's 5 years, so it matures in 2019, and it's paying, because they have a good credit rating, I think single A or whatever, it's paying 3%. The coupon is 3%. Now we need to determine what the cash flows are for this bond. Okay? So, and it pays annually, it doesn't pay semi-annually. So they only pay one coupon a year, so we got year 1, 2, 3, 4, and 5. So at the end of year 1 you get, and then using $1,000 par, not 100. So a coupon of 3% on $1,000 is what, 30?
So year 1, you get $30. Year 2, you get $30. Year 3, you get $30. Year 4, you get $30. In year 5, you get your $1,000 back plus your $30. So you actually get $1,030. Okay? So that's your cash flow. Now, that's great. You fixed your coupon at 3%, but the interest rates aren't 3%. Now, let me give you an example. Let me ask you a question. What we need to do, we need to discount each of these cash flows back. We need to determine the present value of each of these future cash flows. Okay? So, we need what? We need present value equals future value divided by 1 plus R to the T. Alright? If, I got a question for you, and this is one of these questions that will come on exam. If the discount rate is exactly the same as the coupon rate of 3%, exactly the same, what would the present value of these cash flows be? Alright, so the face value of the bond equals 1,000. Alright, we got 1,000 face value back plus 30. My question to you is, what would the present value of all these cash flows be if the discount rate was exactly the same as the coupon rate? That would be 1,000. Alright? Why would I pay more for 3% return when I require 3% return? Why would I pay less? Right? Or why would somebody sell it to me for less, allowing me to get a rate of return in excess of 3% if the market is saying you only need 3%? So if the discount rate is the same as the coupon rate, the value is par, except there's no deviation. If the discount rate is higher than the coupon rate, what do you think happens to the present value? Will it be more or less than 1,000? Let's suppose the discount rate is 4%. When they came out and they issued at 3%, that was great, but now the interest rates have changed. The market is requiring a rate of return of 4%, not 3%. So
the bond is trading at a discount?
The bond would have to trade at a discount. I'd have to get that additional return up front and pay less for these cash flows. And if the rate of return, required rate of return is 2%, then it'll be traded at a premium. All right, because if the market is saying you should only get 2%, why would I sell it to you for anything other than a price that gives you 2%? Why should I give you the return? I want it. All right. So let's do a calculation where let's assume that the rate of return is 4% and 2%. And come up with this value of this bond. That means you're going to have to do 5 separate present value calculations for 10 in total. All right. Let's just do 1. Let's not do 10. Let's do a 4% rate of return. Therefore, we know the present value is going to be less than 1,000. If you get more than 1,000, you know you made a mistake. So the present value factor here is going to be, and let's give you. All right. So here it's going to be 1 divided by 1.04 raised to the power 1, right? Year 1. 1 divided by 1.04 raised to the power 2. 1. 1.04. Aha! We've hit the mother lode of ink. 3, 1.04 to the 4, 1.04 to the 5. And then when you calculated that, you just multiplied 30 by that to give you a present value, right?
do is called the sum of present values. And then you calculate that. While you're doing that calculation, I'll give you a little puzzle. No, I can't. It's such a corny joke. Save that for when you're a little more tired. That's how you get a laugh. You gotta be tired of corny jokes. Otherwise, you think it's silly. See what time it is? We still got, what? Oh yeah, 4 hours? While you're doing that, I'm just gonna got a call from my boss, otherwise my wife. How we doing?
All right, why don't we work through this bond price calculation. So what I'd like to do, I'd like to 1.04. In this case, raise the 1, so nothing. Take the inverse. I guess sometimes you'll see where people will actually put in this figure here, right? So I'm just going to 2 decimal places. It's 0.96. Therefore, the present value is 30 times that, which is 28.85. And we can do the same thing here. $0.92. Have you ever done like discounted cash flow models? You'll often see that they'll actually show these numbers because all, you're valuing a business, for example, right? It's the same concept, is that how much free cash flow do we think this business can produce over this forecast period? And then you discount those cash flows to come up with what you think the present value of each year's cash flow is. And then you make the assumption the business can be sold at the end of the year, the terminal value, which you in turn discount and come up with an estimated value on the company. All right? So 0.92 times 30.
27.
How much?
27.
7. What's this one?
26.67.
26.7.
I thought it says dollar. I thought we were going to decimal points.
Yeah, we can go to
So
27.74.
26.67.
67, okay.
25 spot.
25.65.
65. And $846.59.
59 cents. And then we add all these up. Did anybody do that?
955 spot 50.
955 point
Spot 50.
50. So if I was, requiring a rate of return of 4%, and this bond was for sale, I wouldn't pay $1,000. I'd pay $955.50. All right, and that discount of $44.50 up front allows me to get a overall return of 4%, even though it's only paying me 3% per year. Okay. All right. And that's how bonds are, priced, right? But it changes all the time. So here, the bond was $100, $100, it's $1,000, $1,000, $1,000, regardless of what that is, regardless of what that is, and regardless of what that is. Which really makes no sense, right? So quite often, either if you have one of those older bonds that's coming close to maturity that had a nice coupon of prime plus 2, I tell you what, I'm not selling it for par. And I don't have to sell it for par. I can sell it at a premium, right? And I'll negotiate a premium. Because I don't have to go to the central bank. I can go to the CFALs or the BAFs or the family guardians of the world, and we'll come to an agreement. So, if you got this bond that I can earn, right now I can get 4.8% by buying a government bond, or we can arrange a price where I get 5.25%. Well, we'll find a price that works, we can do a deal. All right, now there's an example basically like that in the text, but in this case it's just saying, if you got $1,000 a year, each year over 5 years, and you discounted at 10%, what would the present value be? So on page 8 you see a table there that shows that the year one's present value is 909. And 826, 751, 683, 620. If we add them all up together, the present value is 3,790.79. So basically what you're saying is, if somebody came to you and said, you know what, I need some money today, and I'll give you $1,000 a year for the next 5 years. How much money can you lend me today? And if I require a 10% rate of return, then I'll say, I can give you 3,790 today. Come to an agreement, then so let's suppose it's kind of a swap, right? I don't have the $1,000 right now, but I know I'm gonna get it. A year from now, I'm gonna get another $1,000. After that, some inheritance I've got, I know it's flowing in, or some investment that's gonna pay me $1,000 a year, but I need money today, and I don't wanna sell that investment, because who knows, maybe that investment goes for 30 years. But I'm willing to sell the first 5 years of those payments of $1,000 to you today for a lump sum. So I can take that money and do something else with it. So there may be a variety of reasons why we do this. Okay. So next we're going to look at valuing level cash flows. So let's read through it. Investors and lenders often encounter situations where they have multiple cash flows that are all the same amount. For example, a very common type of loan repayment plan calls for the borrower to repay a loan by making a series of equal payments for some length of time. Consumer loans, mortgages, the like. A series of constant or level cash flows that occurs at the end of each period for some fixed number of periods is called an ordinary annuity. So let's look at the present value for annuity cash flows. So suppose we are examining an asset that promised to pay $1,000 at the end of each of the next 3 years. The cash flows from that asset are in the form of a 3-year, $1,000 annuity. If we wanted to earn 15% of our money, how much would we offer for this annuity? Wow. That must be like a risk like decoy. Alright. That may need some. But you know, that kind of touches on another point, right? If somebody says, I got this deal, this investment is going to earn a rate of return that sounds exceptional, and it's low risk, it ain't low risk. Sorry. Return and risk, you know, they're inversely related, or they're positively correlated, right? The higher the return, the higher the risk. So always bear that in mind. Ask the questions to weed out exactly where the risk is. So a 15% rate of return is what we're using in our example. All right, so we can discount each of these $1,000 payments back to the present at 15% to determine the total present value, which we did there, and it was done in the table. And we see we get a series of cash flows, present values. We sum them up and we come up with $2,283. Now most situations have larger number of cash flows, making the above approach onerous. I guess, you know, if you got Excel, you can just copy and paste, and that works pretty quickly. But it would be nice if you had one formula that you could just plug in the values and it would spit out the answer. So most situations have large number of cash flows, making the above approach onerous. For example, a typical car loan calls for monthly payments over 3 or more years for a total of at least 36 payments. So let's look at a quicker method. Since the cash flows on an annuity are all the same, we can come up with a very useful variation on the basic present value equation. It turns out that the present value of an annuity of N dollars per period for T periods, when the rate of return or the interest rate per period is R, is given by, let's write that up on the board, annuity present value factor, annuity present value equation. Everybody has this, right? I was in Nova Scotia a couple weeks ago on vacation. I went to this farm, right? It's designed, it's like 1860s. They had a schoolroom, and all the students had a slate board and a piece of slate that they'd write on it. It was literally scrape, no chalk, so back in that day, so they scrape into the toilet. Man, that just sends shivers up. So be thankful we got at least a whiteboard with some erasable ink versus slate. All right, so here's the annuity present value. Equals N times 1 minus, I'm going to put present PVF, present value factor, divided by R. Okay? Expand that out, we get equals N times, this does become a little cumbersome with all of the brackets. Open bracket 1 minus open squeaky bracket 1 divided by 1 plus R
Here, that little t should be an exponential, raised to the power t. Close bracket, divided by r. All right, now don't get too caught up in this. I mean, what does this bit here in the squiggly brackets remind you of? Algebra. Yeah. I think that's our present value factor, right? 1 divided by 1 plus r to the t. So what you do when you get some kind of awkward and cumbersome like this, start in the middle and work your way out, right? So calculate that first, then plug it in. And suddenly it becomes n times 1 minus something divided by r. Not n times 1 minus squiggly 1 divided by 1, So start in the middle and work your way out and simplify it. Okay? Take your time, make sure you're doing it correctly each step. Okay? Alright, so yeah, that's our present value factor. Alright. So let's do an example. So you're a loan officer and you're trying to determine the maximum amount that a prospective client can afford for a car loan. You reviewed the budget, the prospect budget, and have determined that the maximum monthly payment possible is $500 per month. So their TDSR or DSR or whatever ratio that you use, let you know that, you know what, the most you can afford every month is $500, okay? Now the going rate for a car loan is 12% per annum or 1% per month. Also the maximum term is 36 years. The question is, how much can they borrow? So, as I said before, the first thing we'll do is write down what's been given, correct? So what do we know? We know N, right? The big N equals what? That's the 500, right? So that's how much they can afford. R?
12%.
And let's write out the 12% per annum. And we come back to that because we know it's compounded as monthly, right? Or the period is monthly. What is T?
36 months.
3 years. All right, but now we know that we've got to deal with this on a monthly basis, so we have to turn this equals 1% per month. And this equals 36 months. Okay? So the first thing we want to do is calculate the present value factor right in here, okay? We know N, we can plug that in. Why don't we plug in what we got? Then we can start calculating. So we know we got 500 times 1 minus 1 divided by, what is this going to be? 1.0D. The present value factor. 1.0, 1.12 or 1.01? 0.1, right? And it's going to be raised to the power of what? 36. 1 is a monthly rate or monthly interest rate, and it's over 3 years or 36 months. And all of that divided by what? 0.01. These R's are the same, okay? All right? So why don't let's calculate this bit in the middle first. And then I'll get out of the way and people unblocking the view can actually see it. What's 1.01 raised to the power 36? 1.43? 36. 1.43. Inverse of that? 0.7. All right. Now what we've got, we don't even need that squiggly now because we've actually solved for all of this, right? 1 minus 0.7 divided by 0.7. 5.01. All right. Remember now, you always do what's in the middle of the brackets first, correct? And you always do, well, you do exponentially, do what's in the middle of the brackets. We've got to solve for this first. Equals 500 times 0.3. This is all, this here is divided by 0.01. Doesn't really matter, does it? All right. So let's do 0.3 divided by 0.01 equals 30 times 500 equals 15,000. Is that what we say in the notes? And slightly different, 55. Oh yeah, in the notes I took the decimal out. Instead of using 0.7, I used 0.6989. Okay, that accounts for that slight difference. So you can now tell this person the most, you know, you've pre-qualified for an auto loan, but the most you can spend is $15,000, which means you better get a motorbike. Unless you lend for used cars, right? If your institution lends for used cars, and I don't, any new cars at $15,000, I don't know. So that's kind of a very useful, and that's, you know, that's really what the program you have at work. If you work in a bank and you're determining, you know, the total amount, maximum amount the person can borrow. You put this information in. This is the formula that the computer's doing, using and calculating. Okay. Everybody okay with that? I would recommend, right, you got my emails, come up with a different scenario, right? $1,000, you can use 6% per annum, which is 0.5% per month, and do it over 5 years, for example, and calculate what the annuity present value would be. Email it to me, and then I can calculate it and let you know if you've done it right. Okay? Practice, practice, practice. That's the key. All right, so in this case, we found the present value. The next example, we're going to determine n. So what is n? All right. The client comes, oh, don't worry, you know, hey, you don't have to worry about what I get afford per month. This is what I want to borrow. You tell me how much it is, right? It may turn out they're not correct, but that's how they approach it, right? Don't insult me and limit me. You don't know who I am. So in this case, we're going to determine what n is, right? So we kind of came up with a different scenario altogether. This is a company, right? They want to make a Bush tea, right? So it's kind of a health tea product, and they need to borrow $50,000. The interest rate is 15%, and it's for 5 years. Okay. The payments are all equal, so we need to find the relevant annuity factor and solve for the unknown cash flow. All right. So what do we know? Can I erase this up here? All right. Erase from here. Rearrange. I didn't put PV. All right. So let's see. We know the rate is 15%. Per annum, right? We know they need to borrow 50 grand. And it's over 5 years. All right. And It's on an annual basis. You don't have to worry about converting to a monthly or quarterly or semi-annually, and we don't have to increase the number of terms. So let's rearrange the equation and solve for n. This can all be treated as one variable, okay? So n, we divide both sides by that. All right, so I'll work through it. Divided by 1 minus present value factor divided by r equals all of that divided by 1 minus present value factor divided by r. These cancel out. One left with n. We can just flip it around and put n on the left side, just because it's traditionally easy to work. Maybe the Japanese go that way, I don't know. But anyway, we're going to go this way. Actually, mathematics is the universal language, right? So I think that annuity present value divided by 1 minus present value factor r. We're going to have to expand this out, right? Now what we could do is we could actually go over to the side and calculate that, then plug it in. Why do we do that? Can I erase this here? If you came a little late, it was just, showing that if you have an annual rate of 12%, that equates to a semi-annual rate of 6, quarterly of 3, monthly of 1. For 1 year, the term is 1, but for semi-annual, the term is 2, quarterly 4, and monthly 12. Okay? So our present value factor . 1.15 raised to the power of 5 equals what do you get, 2.01 basically? 2.01 inverse, like 0.5. I don't know, we'll just use the 2 decimals. I remember, that's fine, if you go to more decimals you get a slightly different number. Rounded to 2, you get that. But I remember the first time I heard the word pedantic, and I didn't know what it meant, but fortunately I was given a very good example. And I don't mean to say that going to 4 decimals is pedantic. A friend of mine, his doctor said, don't drink too much caffeine. So I saw her making instant coffee, and she counted 8 grains of instant coffee, put it in. And that's pedantic. I take like a quarter of a teaspoon, but don't count, she literally counted 8. I said, okay, I said, that's like taking it to the 20th decimal, that's extreme. All right, so we plug that in. Now, what's really funny, right? Let's go to the what's in the write-up, just to make sure that where the exponentials that should be. So in that example, the very first line, 50,000 equals n times 1 minus 1 divided by 1.15. That second 5 should be an exponential. All right? But here's what's funny, right? I'm talking about being pedantic, and you're quoting what's written in the text. I think that's funny. So 0.4972. Up here I was being lazy. Alright. So we plug that in. And why don't we use what's in the text just to be consistent? Alright. 4972. Alright. Equals 50,000. We know that. We know the annuity present value, right? Divided by 1 minus 0.4972 divided by 0.15 equals 50,000 divided by 0.5028 divided by 0.15 All right, good, it's the same. 14916.47. I think that's what we have in the notes, right? Okay. So, Mr. Island Glenn, you want to borrow 50 grand from me for 5 years, and the rate is 15%. Here's what you got to pay me, the lender, every year. I want $14,916.47. All right. You know, same, just kind of reversing who's in the position of the lender and who's in the position of the borrower, right? Okay. So if I was doing this analysis, then I'd have to look at the companies. Hopefully they've got, if it's a brand new startup, look at their projections, and given the rate of return, the required rate of return is 15%, obviously I view the risk as fairly high. All right, so it's probably a fairly new company that's got this grand idea of expanding and needs to borrow some money to buy new equipment. So there's risk there, and as a result, I want a higher rate of return to compensate me for the additional risk. Okay, if it's like a venture capital project where the person really doesn't have a lot of history, then I may say, you know what, I need 30%. I need a really big rate of return to offset this exceptional risk, because there's a high risk that I won't get my money back. You're going to go bankrupt. So I need to have a higher rate of return. All right? So next we're looking at future value for annuities. So on occasion, it's handy to know a shortcut for calculating the future value of an annuity. For example, suppose you plan to contribute $4,000 every year into an individual retirement account paying 7%. If you retire in 30 years, how much will you have? It should be more something, how much do you expect to have, right? One way to answer this particular problem is to calculate the present value of a $4,000 30-year annuity at 7% to convert it to a lump sum, and then calculate the future value of the lump sum. All right. Let's just go through, make sure we got, in the annuity present value factor, in brackets you got 1 minus 1 divided by 1.07. That 30 should be an exponential. Everybody see what I'm saying? In the notes? I got to speak to, I'll speak to Miguel. We need to get these reprinted with the exponentials where they should be. I think everything else is fine for the rest of that. So we can just talk through this example, and then what we can do is maybe change the scenario and do a new calculation. So that 4,000, we multiply that by 1 minus that present value factor, and then that in total amount is divided by the discount rate of 0.07. So 1 divided by 1.07 raised to the power 30 equals 0.1314. All right. 1 minus 0.1314 divided by 0.07 equals 12.4086. 4,000 times that equals 49,63429. And now we want to know what is the future value of that present value figure. So we take that 49,634.29 and multiply it by 1.07 raised to the power of 30. And we get 377,828.87. All right. So this often strikes home. People have these grand ideas of what I want to retire with X amount of money. Suddenly you say, well, you know, you need to save $4,000 a year over 30 years. That's 7% to get 377,000. Suddenly people are like, oh, all right, maybe I need to rein in my expectations, or maybe 4,000 a year is not only achievable, you can do more, right? If I don't buy that Coke soda, if I don't do this, if I take a packed lunch to work, if I, you know, you start cutting back on your spending, and suddenly you've saved a couple $100 every month. You can plow that into your annual savings, and suddenly perhaps things are achievable. All right. We're almost there. Let's get through this. We got, all right, good. We got 23 minutes, and we got the effective annual rate of return to go through, and then we've got a sample of which investment is the best, and then a very short talk on loan types. So we're right on schedule. The effective annual rate of return. So quite often you'll hear, you know, somebody will quote an annual rate, but if you're able to compound at a period shorter than a year, your effective annual return rate is even higher, right? So they say the annual rate is 10%, but if I can get paid on a quarterly basis and get 2.5% per quarter and earn compounding on my investment over the first quarter, second quarter, third, and the fourth quarter, my effective annual rate of return is higher. Okay, so let's go through this example. All right, let me write it on the board. This also equates to debt, right, in the reverse. You know, you get quoted an annual rate of return, but boy, they're hitting to you every month. Your effective annual rate is more. Like 18% credit cards, right? All right, so scenario one, we invest $1,000 at 10% for 1 year. What do we get? We get $1,100. Scenario two, we invest $1,000 at 10%, but it's compounding quarterly. We want to know what our effective rate of return is. So, future value equals present value times 1 plus r to the t. What do we know? We know the present value equals 1,000. We know r equals 10% per annum. And we know t equals what? 1 year, right? But it's it's quarterly compounding. So really, this also equals 2.5% per quarter, right? 10 divided by 4. And the term is not 1 year, but actually 4 periods. All right. We plug all that in. 1.025 raised to the power of 4. 1,000 times 1.1038 equals 1,138. Flip in 1,103.81. Okay? So we got an extra, what, $3.81, right? Because for 1 year it would be $1,100. So what we do is determine the effective annual rate of return. We'll call it year. 1 plus quoted rate. Well, before we do that, if I subtract the $1,000 that I put in at the beginning, the difference is 103.81. Okay. If I take 103.81 divided by 1,000, I get 0.10381. And if I convert that to a percent, right, I move the decimal 2 places over, what do I get? 10.381. So that's one way to calculate my effective annual rate of return. Okay, where I actually use the numbers. But there's an equation where you don't actually have to go through the calculation to determine the effective annual rate of return.
PRA equals 1 plus quoted rate. The next couple weeks aren't as mathematical, so just to let you know. Give you something to look forward to, you know, before somebody throws something at me. Quoted rate divided by n. Need more room. We already did this, so we can get this out of the way. Power of n, sorry. So what's written in the notes. Once again, that n should be that second n should be an exponential. Minus 1. Let's see if it equates to this. Equals 1 plus 0.10 divided by 4. Raised to the 4 minus 1. That seems to make sense. 1.025 raised to the power of 4 minus 1 equals what? 1. .1038. 8 minus 1 equals 0.1038, which equals 10.38%. So they're pretty much the same, right? This went out one more decimal place. All right, so that's your effective annual rate. You'll have to know to do that. I'm sure that'll come up as a question. Because that's an easy one to throw in, right? I always tell people, you know, if you imagine you're writing the exam and you're coming up with questions on this material, that's an easy one to come up with a question for. So you need to know how to do that. So you got two choices. You can do that long way that we did the first time. We actually do the calculation, get what the return will be with the compounding, and then divide by the initial investment. Sorry, subtract the initial investment, you get the residual and then turn that into a percentage. Or you can memorize this equation and then plug in the figures. You need to ask Miguel if you have to memorize the equations or not. For the CFA exam, you have to memorize the equations. So if it turns out that you have to memorize the equations,
No, it's
students,
open book.
open book?
Yeah.
What? Crazy. That's no fun. So you do the CFA, and as soon as they say go, you start writing down all the equations. Maybe you're going to forget it if you don't write it down. At least that's right. All right, so that's effective annual rate. The last thing we'll do, I mean, I'll let you read about the loans, a pure discount loan, interest-only loan. I think everybody here, unless you're one of the very, very few Bahamians who does not have debt, or has not had debt at some point, then you need to read it in detail. For the rest of us, we're intimately familiar with making monthly payments. We got a scenario here on page 10, underneath the effective annual rate of return. There are 3 investments that all require the investor to invest $1,000 for 5 years, but the interest rate and compounding period differs in each case. So investment 1 is 12% compounded monthly. Investment 2, 12.4% quarterly. Investment 3, 12.8% compounded annually. Don't look at page 11 because the answer in hindsight, I should have left that blank. All right, but why don't we work through it together, and that'll be the last thing tonight. So what you'd have to do in this is make a great exam question as well, right? What would $1,000 compounded monthly at 12% over 5 years equate to? Well, there's my eraser. PV times 1 plus R to the T, right? So in example 1, well, we know present value is 1,000 for all of them. Q1, what is R? The R is 12% per annum, or 1% per month, because it was monthly compounding, right? And T equals 5 years, or 60 periods, right? 12 months a year times 5. You plug all that in, and what do you get? I'll leave you to go through that joyous experience one more time. But the answer is that you get, so, option 1, $1,816.74. Investment 2, that is quarterly, right? So R will be 3%, and T will be 20. So you plug that in, and option 2 gives you 184,150. I remember the first time I did this class, I didn't have to do that.
Mm-hmm.
All right, in Q2, we have annual, right? So R is simply 12.8%, and T equals 5. Plug that in, and we get 1,826,20. And then we say to ourselves, which one is the best one? Well, of course, this one is, right? Because the future value is higher. So we would opt for option 2. All right? So that would be a good question as well. Now, you have to do 3 separate calculations in order to determine the right answer, right? That takes a little longer than doing one calculation. So once again, if you're running short of time, right? Maybe guess an answer and continue on, come back to that, and then do the 3. Because it's also a fairly easy one, right?
Yeah,
So
common sense, yeah.
yeah, to some extent, yeah. Yeah, I mean, if I made it 12% monthly, 12.2% quarterly, and 12.4% annually, determining the difference between 1 and 2 may not be quite as obvious. You have to calculate that. All right, well, that's it for tonight. Any questions? Other than, thank goodness that's over. That's the statement, right? That's not a question. And then once again, you got my email. So if you had some questions you didn't feel like asking, you said, man, we got these smart CFP, BA financial guys, offshore bankers up in here, and I don't want to necessarily ask this question. Email it to me, and I can answer you directly. All right. Next week we're going to look at investment products. I'll try to bring some real-world examples along. All right, a little more math, do a little bit of math, but nothing like today. We calculate P ratios and dividend yields and dividend payout ratio and stuff like that, Any particular topics that somebody, if you got a particular topic you want to talk about in class, email it to me and see if we can incorporate it. Okay.
The sign-in sheet.
Okay. Who didn't sign it? Oh, good. I got 2 for the price of 1. First time in one of these courses they give you got food and stuff in the back.
Yeah, since we start coming. Yeah, just Saturday. I supposed to start Tuesday, but I speak on
I'm good, you?
Christine Martha and Mr. Kirk.
Yeah.
Christine Martha, yeah. And David Brown. I think his training is finished, so when I see it. Yeah, he already did the, he had a pool. He's in the pool.
I feel worse than when I was that. Yeah. I need a vacation. I do. But I need vacation.
Oh, good. No, you are going on vacation. I thought you're complaining. Yeah, I won't be at work, but it won't be vacation.
I mean, yeah. I see, because you were. But
You just came back from
nothing like that.
You still the first
Yeah. No, I'm trying to get clearance and stuff. I must even sleep there tomorrow.
Yeah.
I'm probably gonna sleep there tomorrow.
Okay.
Man, you go on vacation, it's not what you do. You don't want to go. I was waiting for when you get back. I said, boy, I want to go. Just not like that.
How the kids? Well, they go to it. They have so many things.
Okay. Well, that's good. That's why I No. I realize I do
Sign in. Because he gave it to us when you were doing
Because I like to use some kind of.
Yeah.
I've done this 25 or however many years.
I'll try to,
But yeah.
I'll probably Skype.
And I think that'll help me, yeah. Then I'll
Okay.
go online.
I'll try to.
Yeah.
Plug in that after you.
Okay.
But it's always.
It's been busy.
Right.
I had to just get homework.
But
Just to
then,
even.
I just walked in and he was
Let me just.
thank you.
All right, so we can start.
Yeah, okay, thanks.
They used to.
Did we have drinks or?
No drinks today.
Okay. Surely we might have.
Maybe that's what
Oh, is that what it is? Yeah, I'll have a good one.
you too. I didn't get your. I said,
Oh, okay, all right. Yeah, no, I know. I know you're talking about.
Yeah, I just was saying,
Just start now. And the girls, my eldest one's not necessarily super keen, but important to be involved in a program and fitness. And, my youngest one's still keen, you know, wants to make grifter.
fried chicken,
I tried to get in the pool just for fitness too. You need to learn how to swim.
I could swim for 50 minutes. I don't like him to I don't want to tell him what to do.
What a terrible attitude.
Whose stuff are they? Did I leave my stuff?
Somebody may have left.
papers.
It's on this table.
Oh, no, that's just the book.
An extra coffee?
Oh, an extra copy, okay. I find women are easy to teach. When you're an adult, women are easy to teach how to swim than men.
Yeah?
Yeah.
We got a few men recently. I mean,
Yeah, don't get me wrong now, it's just, everybody can learn how to swim. But I think maybe it's an issue of being, the macho aspect, but also, I think,
well, women are naturally buoyant, so.
I was gonna, well, you said it, I was gonna say that women are more, you fit it just right, more buoyant.
Sorry, folks. I couldn't let it go. sorry, no. Sorry, man.
Right on the road. I don't remember.
What you gonna do? Make a recording, man. Put on YouTube. Or you gonna Skype it.